Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti, and on behalf of OTC Markets, we're very pleased you joined us for our next presentation from Yellowcake. Please note you can submit questions for the presenter in the box to the left of the slides. At this point, I'm very pleased to welcome Andre Liebenberg. He's the Chief Executive Officer of Yellowcake PLC, which trades on the OTCQX Best Market under the symbol YLLXF and on the LSE under the symbol YCA. Welcome back, Andre.
John, thank you very much. Let me get going on the presentation. Well, firstly, thank you to all for joining this presentation. I'm going to spend a little time on Yellowcake, the company, and then really spend most of the time on the uranium market, because that's kind of the key driver for the structure that we are. Just turning to Yellowcake, we set the company up in 2018, IPO'd on the London Stock Exchange, and really what we wanted to do was give investors the opportunity of expressing their view in the uranium commodity through our shares. It's very difficult to own the uranium commodity unless you go through a fairly rigorous regulatory process and a costly storage contract process. We're a buy and hold entity. Our strategy is to purchase and hold for the long term. We don't have any operations, so we don't have any risks associated with exploration, development, or the operations of mining and processing plant. We have a contract with Kazatomprom, which is the world's largest and lowest cost producer of uranium. That was a 9-year framework agreement contract that was put in place after our IPO in 2018, and it runs through to 2027. And the importance of that contract is that it allows us to buy up to $100 million of uranium per annum, essentially at the spot price. It's an annual contract that runs from 1 January to 31 December. We can do all of it or none of it, or in multiple tranches each year. But if we don't use it in a particular year, it doesn't roll forward. We just start a new contract the beginning of the following year. In terms of storage, we store our uranium principally at the Cameco facility in Canada, but we've also got some uranium stored in the Orano facility in France. We have a low-cost structure and have an outsourced operating model. So we outsource our bookkeeping, IT, and uranium transactional activities. And the whole intent is to create a very, very low-cost structure. We've only got 2 full-time employees, myself and a CFO. We don't have an office. We both work from home. Our target is to achieve operating cost at less than 1% of NAV. Last year, it was around 0.65%. It'll probably go up a little this year because of storage costs have gone up, but still, we're under the 1% of net asset value. If I just spend a brief moment on our balance sheet, on a pro forma basis, we own almost 22 million pounds of uranium. And if you multiply that by the spot price on the date which the slide was prepared, and add the little bit of cash that we've got a net asset value of $1.7 billion. So when we IPO'd, we raised $200 million, and that has grown quite nicely. Because we've added volume over the time, but most importantly, the uranium price has gone up fairly significantly, and I'll cover that on the next slide. We don't have any debt structures. We don't have any hedges. We're an all equity financed vehicle. So essentially what you see is in front of you, it's the 22 million pounds of uranium and a little bit of cash, and that's it. I just wanted to put the uranium price in some historic context before going on and to talk about the drivers of the uranium price in the recent past. So the Fukushima event happened on the 11th of March 2011, and the spot price at that stage was $68 a pound. Really what we saw in the subsequent decade was demand destruction on a massive scale, and the uranium price fell from the $68 to a low of around $17 a pound in 2017, 2016. At that point, some of the big producers started taking production cuts in order to balance the market. If you applied the spot price at that time to everyone's production, half the industry wouldn't have made money. They were only making money because they had historic contracts at higher prices. As I mentioned, we IPO'd in July 2018. The first sort of impact that we saw on the supply side was COVID. I'll talk later about the supply side and how concentrated it is. But really, during the first advent of COVID, we saw a big chunk of supply come out of the market, being impacted by COVID. And we saw prices jump by about 30–40%. The next event that was of significance was the Sprott Uranium Trust acquired Uranium Participation Corporation and formed the Sprott Physical Uranium Trust and started buying in the spot market in quite an aggressive way. Then in February of 22, we saw the Russian invasion of the Ukraine. And again, I will speak later to Russia's role in the nuclear fuel cycle, and that had a major impact. And more recently, we've seen the price continue to strengthen. I think the uranium price to date is up something like 68%. It's one of the best performing commodities. And we've now hit a high of $81, which is the highest price over the last 15 years. Let me go through the drivers of why we think the price has risen so significantly over the recent past. We've seen a big move on climate change and energy transition. Ever since the Democrats put the US back into the Paris Agreement, we've seen a plethora of announcements around carbon neutrality and carbon zero goals. And this has had a big impact on the demand side. The second factor on the demand side is we've seen a big reactor build program, principally in Asia. We've also seen a number of life extension announcements out of the US and other Western entities. And then, as I mentioned, with the Russian invasion of the Ukraine, that caused a big, relook at energy security and energy independence. Then the fourth demand factor is we've seen an increase in long-term contracting by utilities. And again, I will cover this in a bit more detail later. So those four factors really have driven the demand side in a positive way. And against that, we've got a supply side which is really being challenged. And I'll cover that in a bit more detail a little later. Firstly, if we talk about climate change and energy transition, nuclear is increasingly seen as a contributing technology to a low carbon world. Nuclear power is the lowest carbon emitter on a full cycle basis. It is a reliable 24/7 power generation source. And so, it's starting to get recognized for those attributes. I was at the World Nuclear Association meeting recently in London, and the head of the South Korean nuclear utility made the point that in South Korea, they don't have any wind, and they have a big shortage of space. So neither solar nor wind is really operable or applicable in that jurisdiction, in that country. They import 90% of their energy. So they have to consider nuclear if they want to look at a low carbon future. Global demand for electricity is forecast to grow by something like 50% between 2020 and 2050. Electricity is sort of attributes about 3/4 of the world's carbon emissions. So, if that growth has to be in a low carbon way, nuclear has to play a significant role. And if we look at the latest International Energy Council forecast and their net zero emissions, they're looking at a doubling of nuclear by 2040. If I go on to the second demand driver, we've got 436 operable reactors today in 32 countries, generating about 10% of electricity. If you go back to the time of Fukushima, China had 17 reactors in operation. Today, they've got 55. They're currently building 25 reactors and want to double their nuclear capacity by the end of this decade or early into the next decade. If you look at the growth, we're seeing significant growth in China, in India. Russia is building a number of reactors domestically. We've seen growth in the UAE, Egypt, Turkey. So, a lot of new builds. And then if you go back a little while, the conventional wisdom was that the existing reactor fleet, particularly in the US and in Europe, would decline over time. And that hasn't happened. In fact, we are seeing big moves to keep these existing plants running. We've seen life extensions in the US from 40 to 60 to 80 years. We've seen life extensions in Japan. A number of European countries have turned around. Instead of sort of exiting nuclear, they're now looking at keeping their nuclear fleet alive. And then the other interesting factor in terms of new capacity are these small modular reactors. And they are starting to have an impact. There are something like 76 designs being worked on, supported by major companies like GE, Hitachi, Rolls-Royce, and also by countries, China, the US, Canada, the UK, all putting a lot of effort into these small modular reactors. And because they are smaller, they're much quicker to construct, probably take half the time to construct as a big reactor. A lot of it can be built in a factory. That means the capital costs come down because if you factory build them and assemble on site, it's very different to bespoke building a very large reactor on site. And they've got applications beyond just electricity generation. They can be used to generate desalinated water, district heating, and also green hydrogen. Barclays in one of their estimated the SMR market could be worth $1 trillion by 2050. We're already seeing commercialization of some of these units. One is commercial in China, they're busy building another. But I think by the end of this decade, we'll start seeing the early rollout of this technology. I mentioned the Russian invasion of Ukraine and just wanted to go through why it was such an important issue in the nuclear industry. Russia produces around 10% of the world's uranium, so not a massive player in that part of the chain. But it has about 35% of the world's conversion capacity and 45% of the world's enrichment capacity. If you look at the US, 20% of the enriched fuel going into the US today comes from Russia. And in Europe, that's about 30%. So it had a really big impact on the fuel cycle when that event happened. And we saw the prices of converted material, or the conversion price, went up from about $20, $22 up to $45. And enrichment, the SWU price, went up from $60, $70 up to now around $150. So a big factor in the nuclear fuel cycle. And then just, to add to that point, if you look at the biggest consumers of nuclear fuel, the US produces virtually no domestic uranium. It imports almost 100% of its needs. If you look at China, China has very little domestic uranium, and it relies on imports from abroad and from mines that it owns abroad. It has a significant position in Namibia. The two operating mines in Namibia belong to China, or the Chinese companies, so that gets exported to China. And France, the same. They import a lot of their uranium, and they rely on assets they have abroad. The fourth factor on the demand side is long-term contracting. This industry relies on long-term contracts. Utilities procure about 85% of their uranium needs under long-term contract, and these are typically 5-year contracts, sometimes a bit longer. And if you look at this slide, you'll see that towards the middle back end of this decade, the contract coverage falls off quite rapidly, particularly for the United States. By 2028, they're less than 50% covered. The Europeans have done quite a lot of covering recently, but they also drop off towards the end of this decade. as I mentioned, we have seen a lot of a pickup in contracting. If you go back to say 2013, contracting has been about at half the replacement or fuel burn level. So if you assume you're burning 175 million pounds of uranium fuel a year, contracting has been at about half of that, which has meant that there's been a reliance on secondary sources and inventory drawdown. In 2022, we saw a big kick up in uranium contracting. And again, this year to date, we've seen almost around 150 million pounds put under contract. The biggest players so far have been the Europeans or the non-US. And, the US utilities will need to come to contract quite soon. If you look at just the last 5 years, the difference between primary production and reactive fuel burn, there's been a depletion of around 170 million pounds. So that's almost 1 year's fuel burn has been sort of under contracted in the last 5 years. Then I want to go on to the supply side. And I mentioned at the outset that, this industry is supply challenged. I sat on a panel recently with the Cameco Chief Financial Officer, and he made the comment that the last decade was really all about demand uncertainty in the uranium industry. And that was post the financial crisis and post Fukushima. He said the next decade is going to be about supply uncertainty. We're sitting in a very supply challenged environment. Very little investment has gone in over the last 10 years because we've had declining prices, and that's little investment into exploration and the development of new facilities. And again, on the supply side, 4 countries account for something like 2/3 of the world's uranium resources. 3 countries produce 2/3 of the world's uranium resources. And if you include the top 5 countries, it's 85% of production. Kazakhstan alone produces over 40% of the world's nuclear fuel or uranium. So if you look at a very distributed demand side, I mentioned the 400 odd reactors, and in 32 countries, you've got a supply side that's very, very concentrated. And any challenges, any hiccups on the supply side is going to have an impact on prices. And we saw that, recently we had the coup in Niger, and Niger accounts for 5 million pounds of uranium. So that, in a production, global production of around 145 million pounds, 5 million pounds is significant. Just putting the supply and demand picture together, and if you look at, as we head towards the end of this decade into early next decade, we are going to need big new greenfield projects to meet the demand that is out there. And we know in the mining industry, mining projects don't very often come on stream, on budget, and on time. So, I do see risk out there in terms of the new production. It takes a long time to permit these new facilities. It takes a long time to construct them. We've seen a lot of capital inflation recently. There's not a lot of experienced, qualified people readily available to go onto these new projects. We've seen Cameco in their recent results with the problems they were having at MacArthur River and their mill, attributed to supply chain issues and the availability of skilled people. Kazatomprom are struggling on the production side. They are below their guidance, and again, challenged by supply chain issues and sulfuric acid on their side. So, I do think that this story, certainly in the near term, the next 3 to 5 years, is about the supply side. In the long term, supply will come. Prices will go high enough to induce new supply, and new mines will come on stream. But I think the interesting aspect of this industry is in the next 3 to 5 years, I think the supply side is going to be a real issue. And any hiccups, weather events or labor issues is going to have an impact. So just putting all of that together, I think Yellowcake is very, very well positioned to benefit from these market trends. As I said, there are 4 factors on the demand side. which are all positive: energy transition, decarbonization, energy security, new builds, term contracting. But the challenge is on the supply side, certainly in the near term. We've got a contract with Kazatomprom that allows us to grow essentially at the spot price. We can raise, we can buy $100 million of uranium per annum. So I do believe that Yellowcake is very well positioned to benefit from these market tailwinds. And we do believe that the uranium price still has further to go if you look at those supply-demand fundamentals. So I just want to stop there in terms of the presentation and cover a few questions that have come up quite regularly and frequently. I guess the first question I get asked is, how tight is the spot market? And I would say it's very, very tight. It's if you went into the spot market today and tried to buy 100,000 or 200,000 or even 300,000 pounds, it would certainly have an impact. It wouldn't be easy to find, and it'd be likely to have an impact on the price. I mean, if you went into the market to try and buy £1 million, that would certainly have a significant impact on the price. And again, just want to reference our contract with Kazatomprom. We raised $125 million in October, of which $100 million will go to buying 1.5 million pounds of uranium. And we raised that money against the backdrop of having, to purchase that 1.5 million pounds essentially at the spot price at the time. So that was very valuable. The other question I get asked quite a lot is this overfeeding to underfeeding. And maybe I'll just stop and explain there. Really, in the nuclear fuel cycle, historically, when demand was weak, we saw a lot of excess capacity on the conversion side. So what people tended to do was utilize that surplus capacity and run the machines to produce essentially more uranium or more UF6 out of less uranium inputs. As we go into a demand growth scenario, there is now a shortage of conversion capacity. And so, ideally what you'd like to do is overfeed the converters to allow you to produce more enriched fuel. But because we have a constraint right now on conversion, and that's mainly because of the Russian invasion, we will see overfeeding in due course, but we need to see more conversion capacity built before that happens. But we've certainly seen that underfeeding has stopped. I guess the third and final question I'd like to address is, we have this contract with Kazatomprom. Kazatomprom have recently announced that they are going to increase their production fairly significantly over the next 2 years. As a country, they are meant to be producing around 60 million pounds today, and they want to grow that to about 80 million pounds by 2025. I'm a little skeptical as to whether that will be achieved. I mean, firstly, they're only producing around 53 million pounds today, so underproducing against their guidance. And even if those production targets were reached, the mine that's going to be where most of the expansion will take place is more than half owned by Russia. So that material will most likely go to Russia. And today, about 50% of Kazakhstan's uranium goes to China. So, I'm a bit skeptical as to whether those production targets will be reached. And even if they are, I think very little will go to the West. Most of it will go to Russia and China. I think that's probably where I'd like to wrap up.